All right. So this is part two. All right. So we talked a little bit about that, and let's really kind of focus in on savings, right? And what goes into savings. So the budgeting stuff, and again, it all kind of boils down to, um, you know, being smart on your needs and your wants, right? Making sure that you are fully funding your fixed cost, your needs, and trying to balance out how much you should be spending for those variable things, those wants. But all of you should be thinking about savings. It's hard at first to save money, okay? But it's really something that you should be thinking about. So short-term savings, what I'm talking about are things that you will need in the near future, okay? These are the emergency funds. They're things for, let's say, if you want to go on a vacation, next year. This is your short-term savings, right? So stuff that you're putting away for a rainy day or for an emergency. But all of this money would be staying in kind of your M1, M2 money, right? And you should also be thinking about, all right, if I just all of a sudden quit my job, uh, would I be okay, and how long would I be okay for? Okay. Your long-term investments or your long-term savings are really investments. Sorry. And we're not talking about the econ type of investment. We're talking about the investment that you usually think of. Um, and really the long term we're talking about are things, maybe several years in the future. Retirement is the big thing. Long term, any big long term goals that you have. So maybe you do want to, invest money so that you can, put a down payment on a house 10 years from now or something. That would be something to think about. And like right now, it will change in your life, but like, for us, my family, college is a big thing, right? College is super expensive. It's going to get more expensive by the time my kids get old enough to go. So we're thinking about that stuff right now, and that's your long-term investment. So we wouldn't stash money in our savings account for the kids' college. Okay, we're going to find something that's going to earn us a little bit more interest. All right, so savings, and we're talking about savings accounts here, okay? And this is your short time term. So I'm going to kind of separate savings between saving and investing, okay? So savings, a type of accounts that we're talking about, and you guys know this because we've talked about M1 and M2 money. So your M1 money is your most liquid form, that's your checking. And your checking accounts should always have enough to cover all your usual expenses, okay? That 50% fixed cost, 30% fun, plus a little bit more. Okay. You want to make sure that you are safe, and you're not going to overdraw. Overdrawing can do bad things to your credit score, and it can also just be a pain in the neck. So make sure that you have more than enough money in your checking account. But then all additional money should go in your M2. Okay. This is a savings account that you can set up through your bank. So most of you probably already have a checking account and a savings account. And try to figure out, different ways. So make sure that you're monitoring your checking account, see how much money is in there. If it gets too high, move, that couple dollars, or hundreds of dollars, thousands of dollars that you have in your M1, your checking, over to your savings. And then if you have too much in your savings, try to find some kind of long-term investments for that. So M2 money, your savings account for short-term savings. You want to put enough to cover emergencies and all other things that you are saving for. Okay, so the Sandsguards do 4 months of income in our savings, more or less. Okay, so some months we might look at our savings and be like, ooh, we have too much in there. Okay, we'll call up our financial advisor and we'll say, hey, what can you do with this money? He'll take it and he'll invest it for us, right? Or you could, if you're doing it on your own, you could buy some stocks, buy into a mutual fund, maybe put some stuff into a CD. That's all up to you, okay? If there's not enough, let's say it doesn't cover 4 months, then we got to do some budgeting to make sure that it gets up, that we fill that hopper up. So all additional money that you save should go into long-term investments. So types of debit accounts, your checking account, that's just your M1 money. Remember, your checking account isn't going to make any interest. So the more money you put in there for a long enough time, it's going to lose money because of inflation. So you got to be thinking about inflation rates when you are thinking about investing. Your money market account in your savings account are pretty similar things. They're just accounts that earn you a little bit more, uh, a little bit higher interest rate than your M1 or your checking account. And then a CD is just it's a more of a long term. So you can have a CD for a year or 2 years or a few months or whatever. But basically, you're putting money in to earn a certain interest rate, but you can't touch it until it's up. Okay, so I had one for a long time that was like 7 months, and I just forgot about it, and it would just roll over. So every 7 months, it would just go back into that account. Okay. Let's move on here. Oh, okay. So let's talk about our long-term investments, and that is just investing here. Okay, I don't know why this is. Here we go. Okay. All right. So I'm going to try to do this quick. But what is the difference between investing and saving? So saving is just a portion of your income set aside for the short term. Investing is a portion of your income that is set aside for the long run and or retirement. Money is not easily accessible. It's tied up in assets. It's a great way, and we talked about this, if you want to become wealthy, you have to have assets, right? And so those assets typically earn you money without you even doing anything. And so they're good ways to earn money over time. Okay. And the reason why you want to invest is because you need growth. Okay. And remember, we got to think about interest rates here. And when we're thinking about interest rates, you got to think about inflation. So let's say inflation is about 3% every year, 3 to 4. Okay. So that means that any interest that you want to get growth on, you want to make sure that you're covering 3 to 4%. So something like 6% plus is what you want to get in investments. All right. So you can kind of see if you just kept your money in a savings account, it's going to stay the same, right? But if you invest your money, you're going to see some growth. All right. And that's what you're trying to do. So you're trying to grow your money so that you have more. And the ultimate goal is over this 40-year span is you want to retire. Okay. Now, some of you are saying, well, I want to work my whole life. No, you don't. We don't want you to work. Okay. At some point, we want you to retire so that people that are younger can have a job, right? So once you guys start looking for jobs, you don't want a bunch of old people that just, want to work forever. That's a great way to keep our unemployment rate down is by letting people who are financially, able to retire. So that's the goal. You want to be financially stable so that you can buy a house in Florida and retire someday, right? Now, understanding that some investments have risk, okay? But a big thing is to try to not get too scared about those risks, okay? So many people have lost a lot of money during the COVID crisis, and this obviously isn't showing what's been happening with the COVID crisis. But if you're close to retirement, you're pretty scared. But if you invested over a lifetime, you're probably still doing okay, all right? And this doesn't even show some of the wealth that you had. Okay. Now, a good example is if you look at the peak here, if you invested your money here, okay, and then got super scared here and took out all your money, well, you would have lost out, okay, because things grew over time. And even if we've seen a dip, in 2020 for the COVID crisis, eventually that's going to grow. Okay, so one of the goals is buy low, sell high, right? And that's a pretty a tried and true method. And one of the things that you're trying to do, and the best thing that you can do is compound your interest. All right. So I'm not a huge math guy, and a lot of you have probably seen the compounding interest formula here before. But the idea is this: that if you had $1,000, okay, and you wanted to invest, if you compounded it, let's say twice annually, over 25 years with 6% interest, what you find is that $1,000 will end up being about $4,500. Okay. The way that that works is that instead of that $1,000 earning 6% interest, every time that it grows, so that $1,000, times that 6% interest would be, 1,060. And so the next time that it's compounded or the interest goes into place, it would be 1,060. Okay. So the more times that it compounds and the higher interest rate, the higher number you're going to get. Okay. Now, if you add money to that every year to the 6%, let's say $100 a month, that's not going to be the formula there. It's going to be a geometric series or sequence, or, you guys are math people, are probably more in tune to the mathematic talk there, or vocabulary. But you are going to, it's going to be a geometric something. And so what happens is that that instead of $4,500, if you did that, if you added $100 a month or $1,200 a year, it would be something more like $72,000. Okay, and if it was 7%, it would be $84,000. Right. So, the more times annually, however much that you can add to it, all will help you in the long run. Okay. So types of investments that we see, the common one is stocks. So you can go and you can buy individual stocks. They have bonds, mutual funds. We've talked about bonds. You can go to a bank and buy a bond. Sometimes they're electronic, and you can actually buy a physical piece of paper that says, a bond. Mutual funds are, it's basically, instead of buying one stock, you're buying a series of different stocks in order to kind of hedge your bet a little bit, right? So instead of putting all your money into one individual stock, you're spreading it out over many different stocks to help you out. Cash equivalent, sometimes you just need to hold cash, okay? And, a lot of people during this time, they saw the stock market go. They sold their stocks and then, reinvested once they felt like the market was better. A lot of people just hold cash because it's not losing value, which sometimes stocks do. Index funds, similar to mutual funds, it's instead of, you're spreading out your investment over a series of companies that are part of what is called an index, okay, which is a list of companies that have something in common. The common ones are the S&P 500 and the Dow Jones Industrial Average. So you could invest in those. You could buy a share in each one of those companies and then just follow the index. And then hard assets like real estate, gold, baseball cards, I don't know. So anything that might earn value over time. Okay. So stocks, let's see how much time I have here. Okay, I'm going to stop right there. We'll start with stocks.